Is Verizon Communication Incorporated a good dividend stock? That's what we'll check in this video. If you like my content, please share it in your social networks and put a thumb up for this video. Okay, so we will check if Verizon can fit in a dividend portfolio. Let's start with the stock price. So in 10 years, it didn't double. So it's not that great. We can see that in 2023, it crashed to $27. After that, it rebounded a little for $41. The market cap is $172 billions. So we are in a large cap in the telecommunication services industry. It's an industry with really slow growth because the market is pretty mature. Let's have a look at the revenue growth. As I said, it's pretty slow and pretty small, where the median is less than 1%. And the last 12 months, we had 2.42% revenue growth in the last 12 months, in the trailing 12 months. Okay, so this industry is not growing that much. We only have the new technologies to stimulate growth, but regarding the market, it depends only on population growth, which is pretty slow in the US. We have a $71 billion acquisition accumulated over the 10 last years. So it's a company growing with organic growth. I would say that the organic growth is pretty is null, pretty even negative, and we have a bit of growth with the acquisitions. Let's have a look at the margins. Gross margin is pretty stable. We are around almost at 60%. Which is almost a level where the company has a moat, and maybe they have a small pricing power. At least they are able to keep the cost under control, so that's a good thing. And regarding the operation materialized by the EBITDA margin, I think it's good because it improved over the 10 last years. It started from 34. And now it's at 36.5. So there is an improvement on this front. The operations are pretty efficient, I would say. And regarding the net margin, pretty stable, around 14.4%. This net income converts well into free cash flow margin? I would say yes, because we have a free cash flow margin of around 15.4%. So that's pretty good, and this company is generating a lot of cash. Good stuff here. Let's have a look at the net income conversion into free cash flow. We can see that cumulative on the 10 last years, the cumulative net income is higher than the cumulative free cash flow. So let's have a look about the causes for that. The working capital is positive. That's unfortunate because it means that the company has to keep cash to make to have the operation running. So it's not a big amount of cash, because if you compare to the revenue, for the 12 last months, it's less than, or it's around maybe 5-6%, something like that. So not a big amount of cash compared to the revenues, and maybe it improves over time. Now it worsens over time, because on the 10 last year we had around $49 billion cumulative positive variation in working capital. So this impacts free cash flow, obviously. If you check capital expenditures against depreciation and amortization, we can see that capital expenditure is above depreciation and amortization. The company is still investing in its assets to produce organic growth. Okay, maybe I think it's for the current infrastructure, but also for the next technologies. And we have around $68 billion of other non-cash items. This helps free cash flow. It's you need to check the cash flow statement to understand what is beneath with other non-cash items. I think it's mostly depreciation, so of maybe goodwill, stuff like this. All in all, I think it's better to use the free cash flow than the net income to do a valuation of the company. And since it has a lot of debt, maybe the enterprise value over EBITDA is better for valuation. Let's have a look at the operational profitability materialized by the return on invested capital. The median ROIC on the 10 last years is 13%. Not bad. It decreased a lot since 2020. And it's still, in my opinion, it's stabilized. And now we are around 9.3%, which is not bad because for this kind of industry, you have a weighted average cost of capital of maybe around 7 or 8. So marginally, the company is creating value for its shareholders. So not bad on this front, but it could be improved. Regarding debt, we have a net debt of around $167 billion. It's around 3 times, a bit more, EBITDA, and 8 times free cash flow. It's manageable. At this level, it's manageable because the telecommunication industry is pretty stable. It's like utilities. You can have around 5 times EBITDA over in debt, and it's still fine. It's still manageable because this industry has a lot of visibility on its cash flow. So banks are okay to lend at attractive rates for these companies, and also not too stringent in covenants. So on this front, I think it's fine. Regarding shareholder remuneration, let's have a look at dividends, outstanding shares, and the shareholder yield. So you have $20 billion in free cash flow. The company returned $11.4 billion in dividends to its shareholder. So it's around 50% of free cash flow. So this is sustainable, and I think they are able to increase the free cash flow over time. I think it's there is some dilution, and that's not great especially for dividend companies such as Verizon to have an increasing share count, because there is a small dilution for the shareholders. But okay, that's not that big. So you have to investigate why we have an increasing share count for Verizon. Maybe it's stock options, maybe it's stocks for the employees, but it's okay, a bit dilutive and not that big, and it's manageable at this point, I think. Shareholder yield 6.6%. I think it's very interesting for someone looking for dividend, high dividend yield, and also a secured one. And if we have a look at valuation, we can check the valuation with enterprise value over EBITDA. We have a median of around 6.8. Currently, the valuation sits at 6.1. So maybe 10-15% undervaluation compared to the historical, the median value over 10 years. So I think there is a small margin of safety in this case. We can have a look at comparables. In the US, we have T-Mobile US, for example. The market cap is a bit bigger for T-Mobile, but your valuation is 50% higher. So, in my opinion, it's because T-Mobile has a more attractive profile regarding growth, free cash flow generation, etc. So the idea for Verizon, currently the dividend yield is attractive. The last, I think they had maybe some issues on the last years, especially in 2023, but it seems to be improving, and I think the market didn't see yet all the improvements that were made by the management, and currently it offers a pretty interesting dividend yield, and I think it's secured. So, in my opinion, Verizon is a good dividend stock. I hope you found this video useful. If it's the case, please subscribe to the channel, and I see you in the next video. Bye bye.